In this video, we're going to continue with our discussion on what are the various methods of arriving at an optimal capital structure for a firm. And then we will look at what is the basic difference between the first approach that we have seen and the second approach that we're going to look at now. So we've already seen the cost of capital approach, which is that, we come up with the debt to equity ratio that minimizes the cost of capital. Now we are going to look at the operating income approach, which is also known as the enhanced cost of capital approach. Enhanced cost of capital approach. Earlier, we had just assumed that whatever number minimizes my cost of capital, I would want to go with it. But in real life, things might change in addition to just the cost of capital changing, right? We've already seen there are direct and indirect costs of bankruptcy. And so as you keep increasing the debt in the firm, there will be an impact to the operating income as well. Operating income will start going down, correct? So effectively, as the company borrows money, there are chances that the indirect costs of bankruptcy cause the operating income to fall. If the operating income will fall, then it's possible that because of this, the free cash flow to firm will fall. It will fall. And hence, rather than looking at a single number for the operating income and just looking and saying that cost of capital has to be minimized, what we are saying is that we will now evaluate if the firm value itself changes because of change in the operating income, right? So there are two things happening here. One is your cost of capital is sort of changing, and we've seen that the change will be something like this for cost of capital. The second thing that we are going to look at is that the operating income will also change. This will basically keep going down with an increase in the debt to equity numbers, right? So as you keep taking debt, the bankruptcy costs keep increasing. So the costs of default or bankruptcy, as we have seen, will keep going up, and consequently the operating income will keep going down. Now these costs could include direct costs, these costs could include indirect costs. We've already seen that direct costs are the costs associated with the legal stuff around bankruptcy of a firm. Indirect costs are basically costs which will come due to loss of business and the loss of flexibility of doing business when you are running a lot of debt. Correct? So that is how we will basically look at understanding how do we evaluate all these portions, how does the operating income work, and how do we work out with this sort of an approach overall in the income approach, right? We'll need a few things though. So under the operating income approach, the first things we'll have to figure out what is the level of drop in EBITDA or EBIT with the changes in the rating for the firm, right? So we are saying as the firm keeps increasing the debt, as you keep increasing debt, your rating falls. As the rating falls, EBIT of the firm also falls by this amount. So when we say that the rating has gone to D, we are saying EBIT will fall by 20%. And these numbers could be different. It might make sense to probably do empirical evidence of companies in the past where EBIT has fallen as bankruptcy costs have approached. And in the context of India, you could use examples of companies like Suzlon or Kingfisher who went into debt restructuring after taking a lot of debt. You could try and find out how much has EBIT fallen by year on year. It's a difficult exercise because you don't really know how much of the EBIT has fallen because of the bankruptcy and how much of the EBIT has fallen because of the business conditions. But assuming we find that this is the fall in EBIT, we can now calculate what is going to be the firm value. Remember, we will go back to our discussion of the firm value and we will assume that the firm is in steady state, right? For real analysis, we can actually remove this assumption as well. But in steady state, the firm's value will be free cash flow to firm into 1 plus the growth rate divided by R minus G. That's the total value of the firm, right? And free cash flow to firm, we will have to arrive at an assumption to that. We will also have to arrive at an assumption for the growth rate that we are using here. What is the terminal growth rate that we're going to use for the firm? WACC is already available, and this R, which is the cost of capital, will keep changing across all these levels as we look at it, correct? So that's the discussion. Now let us evaluate the changes here. For that, we first need the EBIT levels for Apollo Tyres, and then we need to reach the free cash flow levels. So current EBIT, which we find for 2016, is 16621 million, right? We'll see how we find this, because the numbers that we get is profit before tax or earnings before tax, and to that, if we add the interest, that should give me the EBIT number, right? We will also assume that the firm is in steady state. When a firm is in steady state, there is no new capex, right? The only capex is the maintenance capex, which is going to be similar to the wear and tear each year. The wear and tear each year is given by the depreciation number. So we're going to assume that the depreciation is the same as the capex. Every year there is some wear and tear, and we just replace that in our capex conditions, right? We assume no change in working capital either. So what we are saying is, once we reach the EBIT, there is no change from there to arriving at the free cash flow to firm. How do we arrive at the free cash flow to firm? We start with EBIT into 1 minus the tax rate plus depreciation minus capex minus change in net working capital. So we are saying this is 0, and we are saying depreciation and capex are the same, so they cancel each other out. So our free cash flow to firm will be EBIT into 1 minus T, right? Let's try and calculate EBIT first. We said 16621. Let's see, where do we get this? So if we go to the profit and loss statement for Apollo Tyres for 2016, you will find that we are looking at this number here, profit before tax 15706, and then we take the finance cost, which is 915. So 15706 plus 915 is going to give me 16621. That's what we are going to put on our Excel file here. So we have 16621. We assume the tax rate, let's increase this. We assume the tax rate to be 30%. So EBIT into 1 minus T is given here. We can check what is the depreciation level. That's about 4238. So we plug in 4238 here. Remember, depreciation and capex are assumed to be the same, so they cancel each other out. And change in working capital is assumed to be 0, so we arrive at free cash flow to firm of 11,635, right? Now we assume terminal growth rate to be 4%. We can now use the formula here to arrive at the FCFF. What is the formula? The formula says I am looking at FCFF into 1 plus the growth rate divided by R minus G, correct? So FCFF into 1 plus the growth rate divided by R minus G is what we are going to look at. So what is the FCFF? Let's go ahead and calculate it. So FCFF is given here, that's 11635 into 1 plus, sorry. So we first link the FCFF here. Let's just link the FCFF here. And the final value that we are looking at will come here, value of the firm. This is going to come in our discussion from FCFF into 1 plus the growth rate. And remember, we'll freeze the growth rate because we'll drag this formula down, divided by cost of capital for the firm, which we have calculated here, minus again the growth rate, which is terminal growth rate, and we freeze that once again. So that's the value that we get for the firm. That's the firm value which we arrive at, correct? Now we have the firm value, we have the FCFF, assuming either current debt equity ratio, or we are saying that, if even the company goes to 0 debt, the benefits of that are already playing out. They're not going to increase the EBIT value anyhow. So now try and calculate what is going to be FCFF based on the fall in EBIT. Since all the other numbers are going to be the same, we can directly assume that FCFF is going to be the same as EBIT into 1 minus T. And so if EBIT falls by 10%, EBIT into 1 minus T will also fall by 10%, and hence FCFF will also fall by 10%. So we can directly assume that fall in EBIT is the same as fall in free cash flow to firm and extend that analysis. So what is going to be my free cash flow to firm? That's going to be 1 minus this 0% fall, or 1 minus whatever the fall is, into the base FCFF value, which is 11,635. We freeze the first cell 11,635, and 1 minus 0% is what we do here. We see here 1 minus 5% is 95%. So 95% into 11,635 gives us the value now. And we can drag it down to get the values, right? Now, so this is the value that we will get for FCFF of this particular firm, assuming that there is a dip in the operating income as given here. Based on this, we will see that initial few years we see the value keeps going up, and then initial few debt to capital ratios, the value keeps going up, and then it will start falling. Now this gives us an interesting understanding that if we incorporate the fact that the fall in EBIT is going to happen, then the highest operating income is this level. Highest value for the firm is this level. And that is almost the same as what is the current debt equity ratio. So in a sense, if we assume that these bankruptcy costs are correct, then the firm maximizes its value at the current debt equity ratio, which is 0.24. We're saying this value at around 0.25. Importantly, this is different from our earlier analysis, which said that debt equity should probably increase to 0.43 and come here, because that's where the cost of capital gets minimized. Now, under enhanced cost of capital approach, we realize that it is not necessary that the minimized cost of capital, which is at a debt to capital ratio of 0.3, is the best point for enhancing the value of the firm. The value of the firm is dependent on what's happening to EBIT levels, and it's probably important for us to see that that causes a scenario from increasing debt, what happens to the firm, correct? So we know that the current debt value is this. If we say that, for example, there is no fall of EBIT till another couple of pointers, right? So then we will see that the value gets maximized somewhere at the new debt to capital ratio that we had seen under our cost of capital approach itself. But if we believe that our earlier assumption of 5 and 7.5 or 8% is correct, and we continue to assume that this is going to be the fall in EBIT, then we realize that the maximization happens at this point. These things will change if we change our capex and depreciation number. These things may change if we change our terminal growth rate number. But usually you will find that if operating income starts falling, then it may not be a great idea for the firm to change the debt equity significantly. So that is what we see here. We go back and revert to our earlier condition. Let's go back to our presentation. We note that under our discussion, as we have seen, assuming that the EBIT falls, note that the assumption we had made was EBIT into 1 minus T is going to be the FCFF. So fall in EBIT will be the same as the fall in FCFF, because we are assuming the firm is in steady state. We'll have to do that anyways. The value of the firm, remember, we have calculated by FCFF into 1 plus growth rate divided by R minus G. G is fixed at 4%. R is coming from the cost of capital table. And based on that, we find that probably the firm's cost of capital should be here, because this is what enhances the firm value. And that was our end objective in the first place, right? That we want to enhance the value of the firm or enhance the shareholder value, which happens here. So practically in that context, what we see, assuming this fall in EBIT number is correct, we find that the firm shouldn't change things dramatically. If we see that this number is also 0% or 1% or something, then we realize that the firm might have to change its capital structure from where it is, right? So that's the operating income approach. That's what we have to discuss in this particular section. As we end this section, a couple of questions. Explain the difference between the operating income approach and the cost of capital approach. And why does the EBIT fall as the firm takes more debt? Thank you.